Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. You're here for the latest in investment and innovations in FinTech. We've got a fantastic panel for you today. We've got Jillian Cohn, who's a partner at Mouro Capital, David Palmer, who is the Chief Product Officer and co-founder of Vodafone's digital asset broker, Anuj Bhardwaj, who's the head of North America at Experian Ventures, and Sanjit, who's the chairman and co-founder of You First Capital. I'm going to let each of these distinguished panelists tell you a little bit about themselves in a moment. But before we do, or I do, I'm going to tell you a little bit about today's program. So we're going to have a panel conversation for about an hour. We'll take Q&A on the back end. If you've got a question, please use the Q&A function. I'm not monitoring the chat because I've got a lot of other tech and conversation to help monitor as well. So it'd be too much for me to handle. Additionally, today's event is recorded. So bright side is if you've missed some or all of it, so long as you have signed up in about a week, we'll make sure that we get you a copy of the recording. Sort of the corollary to that is whether you're watching us live or watching us on a time-shifted basis, fantastic. We're delighted you're here for us and here today. With that in mind, let's get started. I'd like each of the panelists to introduce themselves, tell you a little bit about their fund or company, where they play in terms of vertical and where in the life cycle. And we'll start maybe with Jillian.
Hi, everyone, and thanks, Jason. Happy to be here with you all. As Jason said, my name is Jillian Cohn. I work at a venture fund called Mouro Capital. Mouro is a FinTech-oriented venture fund. We define FinTech a bit broadly, so not only things that you think of as core FinTech, but also enterprise software that sells to financial institutions as one of their core customer segments. And we're a multi-stage fund, so we can really invest anywhere from seed through growth. And we cover a couple different geographies, US, LATAM, and Europe. So quite a broad mandate. And that's us.
Thank you, Jillian. And you're here in the Bay Area with me right now.
Oh, yes, that's right. I sit in San Francisco.
That's right. I'm delighted that we've got a panel with folks all over the world today. So maybe we'll move on to David Palmer.
So I'm David Palmer. I'm the blockchain lead for a global telecommunications company called Vodafone. Out of that communications company, we recently co-founded and innovated a platform called the Digital Asset Broker, which is looking at peer-to-peer transactions of IoT devices using Web3 technology for the identity and wallet technology. I'm happy to and excited about this panel. And I will be in San Francisco, Jason and Jillian, in May. So hoping to see you guys in person there. Thank you.
Well, fantastic. I'd love to meet with you and grateful that you also are on the panel today. Anuj, tell us a little bit about yourself.
Hello, Jason. Hello, everyone. Thanks for having me. I'm Anuj Bhardwaj. I'm part of Experian Ventures. As the name would suggest, we are the CVC arm of Experian PLC. For those of you who don't know Experian is one of the largest information services company operating in financial services. So we provide data, analytics, software solutions, fraud and identity solutions for banks and consumers to make decisions on their credit profiles. We invest, much like Mouro Capital, we invest seed to growth. Our mandate is pretty global. We have team based in Singapore, Sao Paulo, North America, here in London, covering pretty much globe to globe. We don't necessarily have a mandate on particularly anything to do with just the financial return, but the core strategic key piece is very key for us. So pretty much every investment we make, we have some form of partnership, and that could take many shapes and form. We like to kind of co-create value along with the portfolio companies. Some of the notable examples are Finicity, in which we were one of the largest investor. We made an exit to MasterCard, in which we co-created a lot of open banking services alongside them. We were also investors in Grab in Southeast Asia, which went public in 2021. We partnered with Grab on the Grab Financial Services. So pretty broad mandate. And thanks for having me here. Look forward to the discussion today.
Delighted to have you here as well. And last and certainly not least, Sanjit. If you tell us a
Thank
little
you.
bit about yourself. Yeah.
Yeah, thank you, Jason. My name is Sanjit Dang. I'm the co-founder and chairman of UFirst Capital based in Bay Area. I've been in Bay Area for 20 plus years. Last I was at Intel Capital, where I invested in several areas, for example, AI and SaaS software. At UFirst Capital, we invest wherever the use of AI and big data goes, and FinTech has been one of the key areas for us as well. And similar to what Jillian mentioned, our definition of FinTech is broader than just traditional banking. We think that enterprise software is actually quietly ushering in a new era of banking. And that some people may or may not realize. Some of our portfolio companies at a face value, they may look like enterprise software companies, but they're actually serving some of the large institutions, banking institutions, financial institutions, I should say, in the US. And we are stage agnostic, but we like to come in early, seed, Series A. Our check size roughly 5 million. We have done much bigger checks as well. We have made 20 investments so far in the last 3.5 years and have had 5 exits out of that.
Well, fantastic. Welcome back. Thank you, panel, for your time today. I'm delighted to have you here. So as we move on to the conversation, I'd like first, for anybody who's in the room who hasn't completed the audience poll, to please take a moment and do that. We'll take a look at what the survey results are in a minute. But I thought first, for the audience, ahead of today's panel discussion, the panel and I were sort of talking about the state of the market. And I think one thing that we covered is that this is actually a very interesting and exciting time with potentially a lot of opportunity, with some challenges. And I think it'd be helpful to start maybe just by talking a little bit about what the sort of state of the venture market is. So given that sort of a little bit of background, more broadly, as I kind of take a look at some of the data, more broadly, venture has, especially the last 2 quarters of 2022, experienced a fall off in the number of deals and the value of the deals that were done. As we head into this quarter, which is closing tomorrow, also seems like it's a little bit more difficult to raise capital, but I think there are probably some bright spots out there. I'd love to talk to the panel about where those are and where maybe in FinTech or FinTech adjacent, you see some opportunities. We'll start with Anuj.
Sure. I think more broadly, the type of deal flow we're seeing is obviously the funding market is a lot more challenged, especially when you talk about a company that's in A's and B's and C's. It's a lot harder to raise. So back in 2021, 100% year-on-year growth was considered to be a good company. And I think right now we're seeing that even for those very solid business models, it's a challenge. There's a lot more focus on growth, but at what cost? So I think investors are placing a heavy emphasis, especially in this part of the world where I'm currently based, Europe, basing on unit economics and what the operating levers are at the disposal to turn the business profitable. On the other side, we're seeing tremendous amount of seed activity. So there are some verticals in FinTech, especially climate and others, which are a lot of nascent business model coming up and solving key challenges. And those pieces are still attracting tremendous amount of capital. Obviously, it's unfortunate with the broader tech environment right now. There have been a lot of layoffs across the board, but also I think it just creates an opportunity and talent ecosystem that's available for FinTech to tap on. So whilst there's some downside, there is a massive upside that I'm quite excited about.
Open for discussion side, if any other panelists have any.
I can chip in. I agree with what Anuj said, and in addition, I think there is a false sense of security that some entrepreneurs have, that VCs raise big rounds, big funds during COVID time, and hence they have to deploy that capital this year. While that is correct, But I think VCs are also conserving a big chunk of that capital for their existing portfolio companies. So that's something that I think a lot of founders are not acknowledging and internalizing. So fundraising is going to continue to be hard throughout 2023, I believe. And we will also see the emergence of really the die-hard entrepreneurs. The best companies always come out of downturns, keep in mind. So I think we're going into, summer 2023, you're going to start to see entrepreneurs who say, hey, it doesn't matter what the market is. I believe in the idea. I believe in my team. And I'm going to continue my journey. Some are going to fall off and say, hey, I have to go back to corporate life or do other things and come back to entrepreneurship later on. But I think you will see some entrepreneurs continue the journey. In terms of numbers, VC industry, VC-backed investment activity per quarter used to be around 38, 39 billion right before COVID started. And I'm talking of Q1 2020. It jumped up all the way to 94 billion in Q4 2021. And since then, we have seen a steady decline. Last year, Q4 numbers were 36 billion, right back to where pre-COVID numbers were. So I want to put things in perspective. When we say VC activity has slowed down, it's actually back down to the level it was at pre-COVID. We saw almost a 3x jump in numbers during COVID, but that was never sustainable. That was never going to be sustainable. So in a way, it's a reset back to pre-COVID numbers. Now, given the recent SVB and Signature Bank crisis, I think we're going to see a further dip. So we may actually go down to below pre-COVID numbers. Maybe somewhat you'll see that in Q3, probably in Q1 2023. Maybe the second half, Jason, you were talking about numbers coming out. I think the second half of Q1 is going to see that slowdown. And Q2, my guess is will probably come out around 32 billion or maybe even lesser. But, devil is in the details. The challenge is how many new deals are getting funded and at what size. The other thing we have seen is VCs are funding new deals, but they're being picky. So the revenue metrics, your basics, path to profitability, those are going to be the prime questions you should expect from VCs. And when they find a good deal, they're actually doubling down on that. So they're putting more money per deal rather than spray and pray. We have a portfolio company that was out to raise Series C. They wanted to raise only $20 million because that's all they needed. The VC loved the deal. He said, my ticket size will be $22 million. So the startup ended up raising a $30 million round because of that. So that is the second trend that we are seeing. And I think you will see that continuing in 2023. I have more trends and I can add throughout this discussion.
I mean, if I may just come in, Sanjit. So I think we can't hide the elephant in the room, right? So the elephant in the room is over the last 3 weeks, we've seen 4 banks fail. One of them, the biggest startup bank in Silicon Valley, SVB, that comes against economic conditions of raising interest rates, banks being increasingly vulnerable, the Fed and other central banks coming in. So the macroeconomic climate for investment is not great at the moment, right? So that's one thing I think we need to put in there. In terms of VCs, I love the stat you were giving, Sanjit. I think it's really, I'm learning a lot. But I expect that one thing I definitely agree that you said is that if there's a good project, the funding will come for it. And I'd be interested to maybe just bounce back and see and understand, are you seeing a diversion of the VC funding away from Web3 to AI, away from metaverse to AI, or are you seeing it as it was? What are you seeing in that area?
I'm seeing a shift, absolutely. And I think the VCs are making that shift, especially with the rise of ChatGPT and the whole GPT LLM world, the large language model world. I think we're going to see a lot of investment go into AI this year, especially around LLM models. And there's so much debate right now around generative AI. How can you really use it? How can you drive it? And we can use it for FinTech applications big time. I actually think that the next bank is going to come out of this downturn, this opportunity, because that a traditional bank a traditional bank model may or may not be viable going forward, especially in this high interest rate environment. So you're going to start to see somebody come up with fully online, AI-powered digital bank, very little human intervention that can do treasury management as well as the front end, all powered by AI.
Jillian, I just want to make sure if you had any thoughts that you got an opportunity to contribute to the conversation.
Yeah, I think a lot was covered by the other three panelists, but I guess I'll just add one thing around pricing, maybe. So, as you had mentioned, it wasn't just deal volume that fell off a cliff, but also valuations have come down quite a bit. And I think part of the reason, not all of the reason, but part of the reason that volume had fallen off was because there ended up being kind of a big bid-ask spread between what investors were willing to pay and where founders were sort of anchored from a pricing perspective, either because of their prior round or because of what their friend raised at 6 months prior. And I think that there's a little bit of, there's a little more alignment happening now. I think Sanjit said it well when he said, we're returning to normalcy, and there was a two-ish year period of kind of that was an outlier versus the other way around, versus us being in an outlier environment now. And I think founders are recognizing that. And you've seen that not only in public markets with valuations and pricing coming down a lot, but in some very well-known private names as well, taking meaningful down rounds. And even just in conversations that I've had anecdotally with founders, I think there's a lot more recognition by founders and management and the board to say, hey, we know the last price we raised, that was a little crazy, and we're going to be realistic about what we're going to raise at going forward. And so I think now that there's more alignment, we're going to start to see more deal volume, particularly at growth stages where it had really particularly slowed down over the last year plus.
And I'd like to just dovetailing off of that and also kind of interweaving with something that Sanjit had said earlier. I'd like to see if there's any sort of nuts and bolts or actions that you all are conveying to your fintech startup companies that are in your portfolios. I think Sanjit mentioned earlier, encouraging companies to raise more than they think they anticipate. I've heard that actually on other panels too, where one of the concerns is being undercapitalized and, kind of how long, whether we're going to continue to face some headwinds or entrepreneurs will face headwinds in this capital market, in this environment, kind of how long that will stretch. But maybe touch on some nuts and bolts advice and guidance you're giving to portfolio companies or to companies you're speaking with.
I think we are telling them conserve cash, meter down growth, but not too much. Increase partnerships instead of hiring a big sales team, and grow via partnerships, even if that comes at relatively less margins. You take a margin hit, but you still continue to grow your top line, relatively speaking. But I think cash is going to be the king. So the CEO has to keep an eagle eye on cash reserves, and obviously make sure the cash reserves are safe. That's a whole different story as well nowadays. But, assuming the cash reserves are safe, I think the question really is, how do you elongate the runway of a startup by another 6 months, another 9 months, so that the startup has enough time to be ready for the metrics needed for the next funding round? Because the next funding, the next funding round, the VCs are going to ask, let's say it's a Series B round. The VCs are going to ask, okay, show me your recurring revenue growth rate. Show me how many customers there are, how many new logos you are adding, what's your plan? And all of those questions are going to come up, and those are fair questions. So you got to be prepared for that. Another thing that is very important, and it ties directly into the fintech panel discussion, is the lack of venture debt going forward. Silicon Valley Bank was one of the big proponents of venture debt in the Valley and outside, actually. And given what has happened to Silicon Valley Bank, I think we're going to start to see almost, I want to say, clamp down on the venture debt model at an industry level. It is, for those of you who are not familiar with venture debt, it is basically a line of credit given by banks to startups that may or may not have much revenue, but typically the diligence or the collateral that the bank uses is that there is a good VC in the deal. So the line of credit is given on the heels of a new VC funded round. And now the banks are going to say, hey, that might be too risky. And it was non-dilutive. It would extend the runway, typically by, let's say, 6 to 9 months for startups. So it was lovely for the VC and for his or her startup portfolio company. But I think that cushion is going to go away now. So founders are going to be pushed a little harder now, trying to get metrics even faster and conserve the cash.
Yeah, I think there is also an element of looking inside and just evaluating your business model as well. So most of the fintech unicorns we saw them in an environment where the interest rate was super low. The regulatory environment was maturing. The regulations were coming about. I think we are in a state now where adaptiveness of the business model is going to be the key. Some of the lending models that started when the interest rates were pretty much close to zero, and now they're operating in a high interest rate environment. Just relooking whether the core business model makes sense in all environments is pretty key. I think what Sanjit was mentioning about the cash conservation, that's like it's unilaterally every startup founder should be taking into account, if not already, but also just relooking at their existing business. Does it really require a pivot? Is the product right for all seasons in the market? And bearing in mind the economic climate we're going to be in the next couple of years, do their business stand a chance surviving and effectively getting to those metrics also in the current state? So I think there is a lot of soul searching to be done by the founders and understanding whether their products are the right set of products. If not, what needs to change and how quickly.
Yeah, I just wanted to maybe add something on the technology innovation side of it. So, we are in one of the key times, certainly in our generation of technology advancement and innovation, and that's difficult to say with the with some of the mobile and computer revolutions that we've already had, but we're seeing some technologies, Web3, AI, 5G, IoT, a lot of these FinTech technologies come together at the same time. And it is a time when the fueling and the ingredients for innovation are very high, but also at a time where the macroeconomic climate is not conducive to innovation financing, and even where some of the companies that could move into this space and innovate further may be starved of liquidity. So my question is, it's very clear that innovation needs to happen, right? More innovation needs to happen. It's very clear that the ingredients for that are there. Are we going to pause for 5 years while the VC market and the banks get it right? Or, as you said, Sanjit, that a new AI-driven bank will come up. Is there an alternative to this, right? So we had the IPO before, in terms of token funding. Is there something else coming that will fuel the next level of innovation? Because I don't believe for 1 minute that innovation is going to pause for 5 years while the financial markets sorts itself out.
I just wanted to add one really tactical thing on advice for startups. Sorry, not to not answer your question, David. But on the runway piece, which both Sanjit and Anuj mentioned, I think that is really important in an environment where ability to raise capital is a little bit more uncertain. And so I think you probably heard that rule of thumb that a lot of VCs were telling companies was have like 3 to 4 years of runway. This was maybe a year ago. So now say 2 to 3 years of runway. The typical advice you hear on how to calculate that is current cash balance divided by current burn, monthly burn. And I just wanted to share that that is not always the best way to think about runway. Probably for only a minority of companies does burn actually stay the same month to month over an extended period of time. And so you really have to think about, where are you in your business cycle today? Are you going to need to make hires, in which case burn will go up? Are you generating revenue and you have a pretty reliable sales motion and sales cycle where actually revenue is going up every month and you can maintain costs, in which case burn is going down? And so just think about your business a little bit more holistically, run some scenario analyses, and think about, where will you be in X number of years? What will your cash balance look like? Because this back of the envelope math is not really accurate for most folks. And I think that's just important when you're planning.
Yeah, so Jillian, can I just come in back to my point, which was about the sort of reduction in capital available at a time when the ingredients for innovation are very high, and the macroeconomic climate and the VC environment isn't supporting that. So Sanjit, I'm not taking over the podcast, but I just wanted to try and understand whether we're seeing an alternative there, because I'm just protecting the innovation. I'm excited about the innovation, but I'm also a bit nervous about the lack of capital.
I think the lack of capital is relative. Like we discussed, the good startups are getting funded. I don't think it has come to a screeching halt by any means. And I think capital will continue to be deployed, but the ball is right now more in the founder's court to be clear about the idea. If you're at an early stage, seed, pre-seed, be very clear about what you're building, why, bring more potential customer interests or validations, at least even at a pre-product level, or validations of the concept and of the problem statement, build the right team. And there's so much talent available. Layoffs are happening a lot. That's a plus for the startup world. I get resume at least 2 a day of friends, people I know or people I know of, and they say, hey, I just got laid off from Visa or from Amazon or from Facebook, etc. Do you have a portfolio company? I say, yeah, let's chat. So it's a brilliant time to hire some brilliant talent from these corporations. So I think to put a more positive spin on the environment, I think it's back to basics. And if you have the early team and you have the vision and you are at a seed stage, I think you can still raise funding. But you have to think harder. You will have to dig deeper. The 2021 days are gone.
I think also, David, because of the innovation we've seen, and this has been going on for a decade plus, but especially in the last year or so, I think you need less capital to build a company. There's more and more that you can do with technology. And so I agree that I think there's less capital now than there was in 21, but not less than there was in 2018, 2019. But even if there was, I think founders can be really resourceful and leverage tools and resources other than capital, or other than exclusively capital, to execute on their vision.
A good point. A really good point.
Well, maybe now is a decent time to just pause for a moment and share the survey results in terms of who's in the room today. So we've got about 25% from the Bay Area, another roughly 10% from elsewhere in California, a strong contingent of about 30% from the US, some folks from Europe. So thank you for staying up, and thank the panelists who are joining us from Europe for staying up and joining us today. That's about 10%. Asia is about 6%. Africa is 8%. And then we've got folks from somewhere else. Quarter of the room is first-time entrepreneurs, about 10%. I'm kind of rounding some of these numbers up and down. So for those of you who are math strong, forgive me. Serial entrepreneurs, 10%, 20% in early stage companies, 10% in growth. We've got then we got a hodgepodge of mature companies, venture investors, angel investors, and some folks in government. So thank you all for joining, whether you're here live or you're joining asynchronously. We're glad to have you. I'd love to talk about where maybe some of the hot areas are, because we've talked a little bit about kind of where, the capital environment. One thing that I think has been strong is climate and climate tech. I mean, there have been, the Inflation Reduction Act, and there's a lot of government support both here in the U.S. and globally to try and, limit, reduce carbon emissions, reduce our impact on climate. Love to talk a little bit about climate and FinTech, and what we see as hot developments and areas of opportunities for growth and building great companies.
I think we're going to see a big focus on climate tech. It's not a new sector. It's been one of the sectors within the VC industry for at least a decade. But I think given the point you mentioned, Jason, and also the driving factors around the real climate change we are seeing, look at Bay Area, it's been drenched for 4 months. Not seen that forever. We saw the first ever snow. We used to see snow up there in the mountain. You take a picture and that's it. You feel happy. You saw snow, so far away. And now snow is touching the doorstep of Bay Area residents. Climate change is real, and I think we are seeing the tip of the ocean here, tip of the iceberg here, honestly speaking. And I think there are tech solutions that we can leverage to predict climate change, maybe to mitigate some of the risks as well. But FinTech is going to play a big role in that. And I think we're going to see an intersection of I want to actually almost draw a Venn diagram where technologies like AI, climate change, and FinTech are going to come together to solve some massive problems. So we are seeing. And peer-to-peer transactions, peer-to-peer networking, peer-to-peer communication. So think about FinTech broader than just banking. I think that's a misnomer that a lot of people have. When they think of FinTech, they're thinking, hey, okay, payments or bankings or other such fields. But I think it's broader than that, like Jillian mentioned at the start in her introduction as well. And that's exactly how we think as well.
Yeah. I think capital is so core to any economic activity. If the world were to save itself, we have to work towards a net zero. And capital is core to any economic activity. So effectively, if every economic activity is going to net zero, the capital around it has to support that infrastructure for us to get there. Now, on a very simplistic level, think about a normal consumer having a mortgage. So today, for example, in Europe, there were some stats that people were paying roughly 30% of their gross income in energy bills. In some cases, it were much higher than their housing costs, just the energy costs. So I think it's starting to hurt people now. Climate change, obviously the Russian war and Ukraine war added up to it, but people are realizing that lenders are effectively not going to lend to them because they might not be able to fulfill the affordability criteria or lending criteria. So they have to figure out a way to actually make them homes more efficient to even qualify for certain mortgages. Similarly, for any commercial loan, if a bank were to get to net zero, that means that every single piece of business they underwrite, they have to take into account whether the loan they're making is going to follow the same trajectory of getting to the net zero objective for their scope 3 emissions. And that data, everything is going to feed into the core decisioning factor. So much like a credit score, the net zero score of sorts is going to be pivotal in the way we make decisions, even for a company level. So any big corporate or any even SME, they work with a ton of their vendors. Every single vendor has to follow that part for them to get to net zero. So whom do you work with? How do you decide whom do you work with? Are you on that path? Are you not on that path? What the decarbonization journey is going to look like, what investments you need to make in order to do so. It's such a massive, massive industry on its own. And I think that's where FinTech has got so much to offer to actually solve world's biggest problem.
Yeah, if I may, I think the problem is that if you look at the two sort of incentive schemes for business and consumers is maximizing self-interest, and business is maximizing profit, right? And the bottom line, those two things are not conducive or aligned to climate improvement, right? In fact, they're the opposite of it. So you have a system and a financial system which is, which actually goes against, which actually goes against sustainability and incentivizes the opposite. So I think the question is, how do you incentivize, the right behavior or good behavior? How do you reward it? And that will be the key. I think in terms of finance, obviously, is the sledgehammer or the oil that goes behind that, or to make it happen. But actually, I think there's tools in Web3, so carbon offset tokens, traceability. The fact that when you look at tokenization, you can start to make choices about how you invest and how you reinvest and your behaviors. That could actually go some way towards that. But ultimately, you need the right investment. You need the right political and policy decisions to encourage the investment. And I think that's just the bottom line, right? They're not aligned at the moment.
Yeah. David, I think the way you put it, I think there is a carrot and a stick approach here. The carrot approach is take any asset. I think the way you price an asset, it's what's the value now and what's the option value for future. In climate scenario, if there is no future, the option value is zero. So I think that's how the capital allocation decisions are being made. People want to work towards sustainability and a going concern. In a world which is getting under sea, there is no going concern. And very quickly you realize that's your carrot. If you want an optimum future, you have to work towards it. And the stick part is, to be honest, the analogy that I draw with climate is more on the RegTech side. AML, KYC, etc. They add to cost, but not necessarily any reward. But it needs to happen because that's the law of the land, that's the necessity. For example, in UK, it's enshrined in the law that the country has to get to carbon neutral state. So they have to get there. Eventually, that's going to show in form of one or the other regulations where people are mandated to take certain actions, whether they like it or not, whether there's financial reward attached to it or not. So I think those two carrot and stick approach are sort of key in defining and balancing what the necessity and the reward structure is going to be. That's my
it comes down to but I think it comes down to, and I'll speak a bit less, Jason. I just want to get this point across. But it comes down to allocation of capital, right? And how capital, and there's a lot of projects competing for the capital, and that's getting worse. But which ones are winning? So I would ask Sanjit and maybe Jillian, are we seeing projects which are sustainability based, which are environmental based, getting capital awarded to them? Is that part of the criteria that VCs and others are looking at, or are they looking at bottom line returns?
No, I think sustainability is actually a big focus for a lot of VCs. VCs have 42% of US IPO companies are VC backed. So VC industry has a huge social and economic responsibility, right? Beyond just thinking of financial gains. So, and keep in mind, VC firms raise money too. So they're investors called limited partners, short form LPs. They are also pushing the VC firms big time on, hey, what are you driving for sustainability? How are you bringing impact? Similar to how their VCs are being pushed for diversity impact. So these are big themes that are being discussed within the LPGP discussion forums. And because of that, VCs are driving investments. I know Ignition Partners, one of the general partners there at Ignition Partners, Nick, he has invested in a company that is leveraging data, publicly available data, to predict earthquakes hours in advance, not seconds in advance, right? Or for other such catastrophic events, but in advance, right? Similarly, there's a lot of focus on decarbonization, investments going into decarbonization. How do we drive that? So I totally believe that technologies like AI will be at the center of that sustainability momentum. Jillian?
Yeah, I think, I mean, there's a bunch of different profiles of not only funds, but LPs and other capital allocators, and some are focused only on social responsibility, and some are focused only, or I'd say many are focused only on financial return. And sometimes those are in conflict, but not always. And so I think actually, as there's been more government, as Anuj said, more government movement towards climate friendly policies, climate requirements, even those that are just financially motivated see a big market in the climate arena. So to your question, David, absolutely, we've seen a lot of companies receiving venture funding that are climate oriented. Some of them are probably impact oriented investors and some are not at all. But I think everyone agrees there's a big market to be had, especially if regulation keeps moving in the direction that it's moving.
Right. I mean, it sort of seems that, the regulation is trying to fix a bit of a market failure, which might be a bit of an understatement. But in terms of taking into account the externalities of some of these things that are imposed on the environment, right, and pricing them in. And so to the extent that that happens, even if you are truly purely financially motivated, it's going to be impactful and it's going to be something you're going to be taking a look at and monitoring and managing. AI is in here. AI can solve the world's problems. AI may cause the world's problems. It may be somewhere in the middle. What do we see? What are some of the applications or what are some of the applications that AI can bring to bear with respect to FinTech in this sector? We've talked about it or touched on it, but I'd like to really plumb that a little bit more and see where we think that's going to create some opportunities.
I think treasury management is the next big AI opportunity, and not just for financial institutions, but also for other organizations, including corporations. So how do you manage cash? And that's always been a big problem. Big companies like Apple, Cisco, etc., they have tens of billions of dollars of cash. Then how do you manage that? Where do you invest in? And as the markets evolve, for example, interest rates go up, how do you reallocate that cash? And obviously there are more established models, there are experts, human experts, but sometimes that's not enough. And the reality is the challenges we face are new. So with every downturn, the challenges are unprecedented. So now you have to replenish your models, come up with data, and how do you project the impact? I think it's a difficult problem, and this is where AI can probably help. Yeah. So that's one obvious opportunity.
I think AI is super broad as a topic area, and so I think I would maybe even narrow down a little bit on like what are we talking about? So probably the new hottest topic is LLM, large language models, or generative AI. And there it's really around, I think the opportunities are really around like individual people interacting with AI rather than a human. And so at least in the financial services arena, the use case I've seen the most often, and too often probably, is customer service run by AI. And so it's basically like a more advanced version of a chatbot. But if you think about sort of broader AI, you can think about just leveraging large amounts of data to make decisions. And so there you have use cases across credit underwriting, insurance underwriting, treasury management, as Sanjit said, or investment management. But I think I almost sort of segment those two, even though they're both AI.
Yeah.
Go on.
I think just to kind of add to what Jillian was saying, right? There is ultimately it's data. AI is helping a lot of data to make a decision. So the raw material that the AI models are using, data, that's also opening up. And I think the type of sources that are available now are a lot more holistic and actually can create a much more robust picture for an AI. So give an example, open banking started a bunch of years ago. Couple of years ago, we started to see payroll data coming mainstream and making some certain decisions. Cloud accounting data is pretty mainstream. And if you look at the broader open data ecosystem, right from your assets, right from your pension, right from your savings, from your insurance data, and all sorts of things. So I think there is a lot of data that's been fed and available now for AI models to digest and effectively make a much more smarter decision versus what could have been possible a couple of years ago. And I think that's what sort of makes AI that more exciting, is just the ecosystem and the raw material available for it to process.
Yeah, I'd like to maybe comment. Open AI or generative AI is has hit the headlines this year in a big way. If you look at some of the sort of headlines on it, Bill Gates is sort of saying AI will change the way people work, learn, travel, get healthcare, and communicate with each other. The CEO of OpenAI, Sam Altman, is saying AI will reshape society, acknowledges the risk though, so he's a bit scared of it. And Elon Musk is saying it's one of the biggest risks to civilization. Goldman Sachs came out this week and said it's got the potential to lead to 300 million job losses. So it's clearly got a lot of capacity. Is it here already? Well, I think the majority of trading, if you look at trading of Forex and other things, is done by computers already, whether it's generative AI or sort of other types of machine learning, that's already happening. Could generative AI be able to provide dynamic decisions along with APIs for open banking and FinTech? I think absolutely yes. I think they're already doing that in the background. Could we have, as Sanjit put at the beginning, AI banks? Maybe that can come in the future. But I think one thing is very clear is that the technology is getting better. It's getting faster. There's more channels to feed it now, including voice. So it will be a bigger part of our lives. It will be a bigger part of our financial lives, and it may actually, as sort of FinTech and open banking has done in Europe, provide an opportunity for others to enter the market, right? And I think that's when you'll start to see, a bigger part of AI and other technology coming in.
So we've got about 10 minutes left. I'd like to shift to a different related topic, which is sort of demographically driven, which is the change, the baby boomers being the elder generation, sort of the wealth transfer that's going to occur sort of in the next 10 to 20 years. And that's already actually started, as well as maybe some of the challenges as they continue to enter and get further into their retirement. What are some of the opportunities that you all are seeing in the marketplace for companies that are trying to deal with some of these challenges?
Yeah, I think the whole demographic piece, especially if we talk about the developed markets, right? There's a short trend of aging population, and there are two very opposite problems or sort of opportunities that potentially FinTech can step in to solve. There is one around the wealth transfer. So I think there was over 70 trillion or something that's sitting with boomers that potentially will be passed on to millennials or Gen X. But the makeup of that audience is very different. It's not the old school money that's flowing in. I think what tech has done is also created a new set of wealthy people who are much more informed, who are much more culturally diverse. They have choices around what type of investments they want to make. And it's a different way they want to interact with it. So a standard wealth management practice of 5 suited people walking into your seaside home, I don't think so that sort of environment is welcomed anymore. So there's an opportunity for a neo wealth manager of sorts. But I think on the other side of spectrum, if you take US for an example, the contribution and benefits distributed, so the contribution as a percentage of GDP and benefits distributed as a percent of GDP, that gap is growing. I think it was pretty balanced in 10, 15 years ago. Right now, that balance is roughly 1.5% of GDP. And in some OECD countries, it's much, much, much larger. And I think that's impacting people in real time. You're seeing France raising the average retirement age for people from 60 to 62. That has led to massive protests across France. So it's literally telling people that the choices you used to have, you're not going to have it anymore. That's where I think FinTech steps in and try to solve that gap. The biggest thing in creating wealth is discipline. Unfortunately, as humans, sometimes we don't have that discipline. And this is where technology can really help inculcate those right set of attributes for us to solve challenges on that vertical. Curious if any other the panelists have a view on
it. Okay, I guess not. Maybe we can touch, and maybe we could loop it into this, which is sort of DeFi and blockchain. What applications do we see? I think maybe this is sort of geared towards David, because you have a lot of expertise in this space. But in the last 5 minutes or so that we've got together, I'd like to talk about those two technologies and what is the latest in the marketplace that you're seeing.
Interesting, because again, this year hasn't been wonderful for Web3 in terms of the actual market is starting to pick up now. But what you're seeing is some consolidation of what we call the infrastructure at layer one. So a lot of the key protocols are sort of consolidating in the sense that you have the Ethereum virtual machine, which is sort of key to running smart contracts against the layer one blockchains. So I think you're seeing a lot of that at the layer one, and then you're seeing a lot of emphasis and investment, I believe, at layer two, which is off-chain transactions, which can make processing on the blockchain cheaper and faster. And a lot of the innovation now, I believe, or the speed of innovation is at layer two. So you're starting to see a lot of you're starting to see a lot of what we call optimistic roll-ups. You're starting to see a lot of movements in ZK, so zero knowledge proofs and ZK snarks. You're starting to see a lot of work on wallets. So I've been on sort of 3 talks on wallets just this week, and that's not just in the Web3 world. You're starting to see interoperability of Web3 wallets using things like Wallet Connect, the Wallet Connect framework. But you're also seeing wallets being mandated by the European Union, open wallet foundations stemming up. We saw this week Apple launched the Buy Now, Pay Later product, which is accessed via their wallet. So the wallets are, there's definitely a lead in terms of innovating wallets and adding smart contract capability to wallets in Web3. And that is now starting to interoperate across layer ones and also lead to integration with traditional banking and other fintech wallets. So that is pretty exciting. But if you look at DeFi, the trend is for DeFi 2.0. DeFi 2.0, we're starting to see more integration with fintech. We're starting to see less capital needing to be evolved, and we're just starting to see it mature. So I think DeFi, but of course the macroeconomic environment of high interest rates are making it less attractive. So I think, as Sanjit was saying, and I expect this to apply to DeFi as well, we'll see more innovation, right? We're going to see more innovation of that product. And incidentally, I mean, what's really interesting is you're seeing a lot of banking and fintech companies looking at the models that have been set out. So that's what you're seeing from a corporate point of view. What's interesting is that I sort of come from a corporate Web3 angle, and we started a platform, blockchain platform, as an enterprise. I believe we're one of the first to have launched something like that live. But we started from a permission blockchain angle. So this is where you can control who's in or out. From an enterprise side, we're now seeing a lot of movement towards public blockchains, which would have been unheard of 2-3 years ago. And you're starting to see what you call permission public. So these are permission chains that somehow reach out to public blockchains. But what you're really seeing now are public blockchains that can have permissioned sort of streams to them. And that's something that is, from a business point of view, it's important, because what we saw with the merge of Ethereum and some of the other initiatives is we're getting to the stage now where public blockchains are beginning to be seen as reliable enough for enterprises to start using them, and that could be the big turning point where the emphasis isn't going into permission, but actually enterprises start building on public blockchains. And I think that will be an important phase in the evolution of Web3 into business.
I think if I may add, I agree with what David said. I'm a firm believer in the power of decentralization. And I think blockchain has immense potential in enabling that. Crypto is a whole different world, and I don't want to get into that. I think blockchain as the underlying technological fundamental block is quite powerful. It enables trust between strangers. It enables a much more streamlined ecosystem. It has so many efficiency-related advantages. The challenge has been, where will blockchain find its first killer app? Obviously, crypto, Bitcoin, all those currencies, yes, but beyond that, can we apply blockchain to industrial applications? Can we apply blockchain to retail, supply chain applications? For example, if you buy a piece of salmon in Walmart, you should be able to tell, was it maintained within a certain temperature range throughout the shipment process? Today, you cannot. Or another example is, if I go to Walgreens and buy Tylenol, should I be able to tell where it was manufactured? Should I have a barcode where, if I scan that, and I'll get the full history of that specific bottle of medicine? So blockchain can build trust between the strangers on a chain, but also between consumers and merchants as well. So I believe in the power of blockchain. The challenge has been when and why now. I think why now has not been answered well by the blockchain companies so far. You can show promise, but I think the big companies giving pilots or trying to adopt these solutions are just not ready.
I agree. And one thing I'd add there is that I think what is becoming clear, is that, blockchain and Web3 needs other things. So I think the approach before was for these technologies to sit in isolation, and you approach them, you go to the platform and you approach them and use the technologies. And actually we're in a joined up world. And what we're seeing now is that, Web3, metaverse, AI, 5G, FinTech, all come together, right? And they all work together. You could argue that Web3 is the ecosystem, an automation engine providing community, a voice, and governance. But metaverse, when you think of metaverse and AI, when we thought of metaverse, it was just about games. But actually, if you have AI which can carry out a medical procedure, and you have an immersive technology which will allow doctors around the world to to actually collaborate and do something. Metaverse could be the sort of AI on earth, right? And then when you look at fintech and other aspects of business, they just the power will be in how these technologies come together. And I think we can't look at Web3, metaverse, and these technologies in isolation anymore. I think, and I would like to think going forwards, that the power will be on how you put these components and these ingredients together to solve real problems and realize real opportunities.
Well, fantastic. Thank you very much, panel. That closes out our panel discussion. We're going to pivot over and take some questions and answers at this point. And what I'd like to do is encourage the audience to utilize the Q&A function because we'll be monitoring that. And we're going to take questions that are of general applicability first and foremost. So if you've got a specific question that's maybe relating to your company or startup, we probably won't get to that, but we will certainly try and get to questions on general applicability. Well, one question sort of relates to, I believe, black swan events. So things that are on the horizon that we're not necessarily anticipating or expecting. Maybe, maybe the conflict in the Ukraine last year, or SVB's collapse kind of falls into that category. But have any of those events, or are there other things that have begat a new sort of risk analysis, or anything that you all are looking to try and see on the horizon to avoid sort of complications for either your funds, your company, or your portfolio companies?
Well, I think at a macro level, from a banking industry standpoint, we're going to see tighter credit conditions coming, likely, across the board, and specifically for the innovation ecosystem, the startup ecosystem. If you start looking at the percentage cumulative assets on the balance sheets of banks, Silicon Valley, used to sit somewhere around 62%. And I think all the other banks, the smaller banks similar in size to SVB or even smaller than SVB, have even higher percentages. So because of that, I think we're gonna start to see some tightening of credit conditions. We're probably also going to see consolidation in the banking industry. So that's going to be a trend going forward, where smaller banks are going to say, hey, I can survive on my own, but do I have protection against incidents that happened to Silicon Valley Bank and Signature Bank? So we are going to start to see proactive consolidation within the banking industry, where smaller banks may merge or get acquired by the bigger banks, or get consolidated, or get strengthened rather by bigger banks, like what we saw in the case of First Republic Bank. And you're gonna start to see where regional banks will say, hey, what does my future look like? So that's going to affect the startup world. That's going to affect where you bank. That's going to affect you as a consumer as well. And overall, FDIC has done a fantastic job in maintaining faith in the US banking ecosystem, and I think they'll continue to do that, hopefully. But you will have to think, as a startup, where do I bank?
I think by definition, you can't really predict what a specific black swan event will be. I think you can, as a startup, you can kind of protect yourself, a startup or a fund or whoever you are, you can kind of protect yourself, mitigate risk in a bunch of different ways. But I think your question was a little bit more around how can you take advantage of black swan events to have kind of the next, big unicorn business. And it's hard to say, just because you don't know what black swan events are going to come, and hopefully none in the near term. I feel like we've had enough for the last couple of years. But I will say, I think it is important to really understand, I think this was brought up earlier, but understand the market environment that you're building in and whether or not it's temporary. So there were a bunch of business models that worked really well in a zero interest rate environment. Now there's a bunch of companies starting, particularly in the treasury management space, that are offering, 5% yields to companies, which works today when interest rates are what they are. But may not work in 3 years or 5 years when, knock on wood, interest rates come back down. And so I think you really have to think about like, okay, maybe that's a wedge right now that I can take advantage of because of an event that happened. But how can I build actually a sustainable business around that so that when the environment changes, I'm still in a really strong position and not subject to the whims of the macro environment, whatever that may be.
Fantastic. I mean, I like that answer very much. I like the sort of theme of also like thinking deeper, whether that's sort of examining rules of thumb. You mentioned that earlier, Jillian. Like, I feel like that's sometimes a little bit of a trap for entrepreneurs. To really understand your business, you got to dig under why that's the rule of thumb and does it really apply? Or in this case, really think about your business and is this just a quick buck today, but it's not really a flash in the pan, if you will, but won't pan out, to just sort of make a terrible pun. So sorry, everyone, I'm a dad. I do have a sort of a softball question for everybody that I did not submit, but this is in there. I think, we've got 4 great panelists, all coming from different backgrounds, corporate venture, and also a more traditional fund. The question really is like, what is it that your fund or company brings to the table as an investor that makes you unique and gives you, gives your portfolio companies an advantage? So maybe a chance for you to talk about why you're, what distinguishes you. We'll start maybe with David.
So sorry, I didn't get the question. I was struggling to.
No problem. So one of the advantages, one of the things that startups usually look for is an investor that's not just bringing money to the table, but also an opportunity. There's connections or mentorship or ability to create commercial contracts and partnerships. What are some of the unique selling points of your fund or your company? In your case, David, it's Vodafone.
Yeah. So from our point of view, we're seeing that key is being able to bring real customers, to have a trusted brand, to have things that give you a head start. So when we got funding for the digital asset broker platform from Vodafone, so I'm wearing 2 hats there. Part of it was to be able to leverage 400 million mobile phone contracts, 160 million devices, a global brand, global channels, those things immediately allow a sort of startup with a sort of big mothership to be able to sort of kickstart and accelerate the sort of ecosystem and growth. I think more and more you're looking at that, right? I think there's so many startups that you can get lost. You can get lost. I mean, it was cool, but now there's just so many you can get lost. So what is the differentiator? I think the differentiators, yes, the idea, but it's how you get that out there, how you can actually get it out there, make it real, how you can have some credibility with real customers solving real problems. And I think those are the differentiators that are important now.
Fantastic. Anuj?
Yeah, I think the answer is in 2 parts. One is, as a corporate or a fund, what sort of platform are you able to offer to your portfolio companies? I think in our case, the answer is pretty simple. Pretty much every investment we make, we actually articulate the value upfront. In most cases, we offer up a dose to our customers, co-create things together. And I think over decades, our company and its people have learned a lot of knowledge. And I think giving that access to the knowledge to start up early on in the development cycle, it's super helpful. It's also about product validation. When you work with a big entity who've seen different things, it just gives confidence on the product, and it's also a stamp of validation. And I think just on the personal level, being a founder, let's be honest, founder do the majority of the work. And as an investor, you can guide them on various topics. But at the end of the day, what a founder is really looking for is a trusted advisor. It's a very lonely journey to be a founder. And they go through a massive grind before they see before they taste success. And in that grind period, just being there for the founder and being the trusted advisor that they can actually see comfort from is super important. And I think that's the kind of biggest job for us as investors.
Thank you, Anuj. Jillian?
Yeah. So I think you should ask this question to every fund that you talk to, and every fund will have a slightly different answer. We, as other investors on this panel, are very sector focused. And so because of that, we really deeply understand FinTech. We have a really deep network within the financial services ecosystem, particularly on the customer and partner side, but also in terms of potential talent, and if you're a lender, debt funds. And so I think that's where we can really provide a lot of support in addition to capital, as well as just general kind of strategy. I mean, our team has been investing for quite a long time, and we're active on boards that can help you think about board construction and strategy, fundraising strategy, and all of that. But I think it's actually, if you're thinking about how do you construct a round, I think it's helpful to have maybe a sector-oriented fund that really has deep knowledge in the vertical that you're operating in, and then maybe a more generalist fund that may have a much bigger staff and maybe has like a talent arm and an ops arm and a comms arm that can help you with more of like the operational component. So really important question to be asking.
Thank you. Thank you. And Sanjit?
Hey, sorry. So I think for us, bringing corporations as help to startups has been a key hallmark. When we say that line, we're not talking at a high level, just introduction. We're very close to some corporations and what their strategic interests are, what they are looking to invest in, what they're looking to fund from a business standpoint. So we are able to line up startups accordingly, where in a very unique manner compared to what other VCs are able to do. And this is not just yet another introduction to some CIO, CTO friend. No, we understand what the corporation needs. They tell us, here are my 3 priorities. So that's how we line up the startup. I think it has been super helpful to our portfolio companies and to other startups in our ecosystem in being able to bring that connection. So that's one value add. Other than that, both Ekta and I, the 2 founders of UFirst Capital, think technical first, financial second. We are both technical PhDs. Ekta has a physics PhD. I have an engineering PhD. So when we look at company, we're looking at your technology as well, quite deeply. And we really try to drive, help bring value on the technology side as well. We're not going to start coding your product, but we can understand at a much deeper level compared to most VCs.
Fantastic. Thank you, Sanjit. And I, of course, would not miss this opportunity for myself, but I'll keep it super brief. Obviously, my background is as an emerging growth venture capital attorney. I work with companies all the time from formation through financings, but what distinguishes me from many others in a very crowded field is that I'm an entrepreneur myself. I've started my own firm with no clients. So I know it's like to start basically from nothing and build something. And I bring that to the table. And then K&L Gates is a fantastic platform because we know tech, we know venture. We've got a global platform. So we've got nearly 50 offices on 5 different continents with nearly 2,000 attorneys and deep experience in the regulatory space, including in financial services. So that's something that many other firms can't even come close to matching. I'd like to pivot, because I don't like really selling myself that much, but I'd like to pivot if I can, to talk about a question I think comes maybe from a first-time entrepreneur, but there are many of them in this room. And I think entrepreneurship is an amalgam of skills that you can get better at by education and training and experience and practice. The question really gets to, and it kind of touches on something that Jillian mentioned earlier, which is like, there's a lot of opportunity to build a great business without expending quite as much capital as you may have had to before. because there's new technologies out there. This particular question is talking about no code or low code or no code third-party platforms to develop and build technology. And I'd like to work that aspect in, but I think maybe asking a little bit more broadly as you're kind of thinking about and making an investment in a company and you're taking a look and you're doing diligence on the tech and maybe some sort of diligence on the IP, like what is the framework that you're looking at and thinking about, if you could articulate that? Because I think obviously one application is no code or low code third-party platforms, but I think that the issues that come up cross over more broadly to technology and IP ownership.
Dead on arrival from now on. That's what I would tell all low code, no code companies that are trying to still create solutions and trying to usher in this whole no code, low code era. GPT can do the code. Sorry, customers don't need you anymore. I'm sorry to be so blunt, but I would rather tell you the harsh reality from my standpoint. I could be wrong, and I'm happy to be wrong. But I think that's what we are hearing.
Yeah, I mean, I probably would put another angle on it, Sanjit, which is if you look at smart contracts, for example, great promise. I think the use of smart contracts, especially where they are, in the future, smart legal agreements, could change could remove some friction to doing business and increase automation. At the moment, that is coding, right? It's a coding job to develop smart contracts. If they're going to be used in wider business, actually having object-oriented, user-friendly, configurable smart contracts, which are no code, could be something that's pretty good, right? Would I trust ChatGPT to do that? I don't think it would be able to do it. And I don't think it would know how to configure it, because the configuration may be based on instinct, it may be based on business positioning, it may be based on a business strategy, which is changing dynamically. So in that case, I still think that there is a need in that area. We have a need in that area to develop that. So I think there are pockets of opportunity. If it's solving the right problem. And it goes back to the thing that we've been saying all along, is that you got to make sure you're solving a problem and not pushing a technology for the sake of it.
So my understanding of the question was a little more around, like, would I as an investor be comfortable investing in a company that's leveraging some of these technologies as part of their core tech stack? Is that right?
Yeah, I think so. But understanding you may not, you may not have a specific answer, but like, what's the framework that you would if you were evaluating one of those? Yeah, what's the framework?
Yeah, so I think it's fine whether that's a low code, no code platform, a generative AI platform, whatever it may be. I would say, like, don't have your secret sauce outsourced. Like, if it's the thing that makes your company special, the thing that's really driving value for your customers, and you're not really the one doing it, that makes it really tricky from an investment perspective. And then I guess it's not really your secret sauce. It's maybe the company's secret sauce that you're building on top of. But I think that's fine. And then what can happen is, over time, maybe you build that out yourself as you have a bigger team and more resources, and you figure out how it really fits within your business. Or maybe you don't. I mean, there's plenty of large companies that use a bunch of tools to support particularly internal tooling, but external tooling as well. And I think about this, like, I think about it also from a risk management perspective. So if you have some important pieces of your business built on another company, and then that company doesn't get funding and has to shut down, what happens to you? And I think this is broader than just technology. I mean, we saw this in FinTech, even with FinTechs that were working with a single partner bank, or were built on SVB rails, and all of a sudden they don't know, oh my gosh, are my payments going to go through next week? And so I think, like, think about everything you do from a risk management perspective, have multiple relationships, have a plan B in case something happens with one of your partners that's kind of critical to how your business operates. And I think as an investor, that's something that we would talk about. But if you have a good plan and a good rationale, then I'm comfortable with it.
Yeah, I think there is low code, no code. When you're conceptualizing, even when you're starting out thinking about an idea, maybe it's good from a stack perspective, maybe it's good for a prototype, but not necessarily building your core product on it. But low code, no code as a product that you offer to customer, I think that definitely has value. So if you look at majority of the enterprise platforms, enterprise software, the underlying user are business owners or making some sort of business decision, not necessarily coder by any chance. If you empower them to actually do things on their own in a self-service format, I think that can be really game-changing and powerful. And you're able to build much more compelling or loyal customer base as a result, who are not necessarily relying on a company to customize every piece of software. Rather, they feel more empowered to be able to do it themselves. So from a tech stack perspective, a no-go area, but from a consumer perspective in which you're offering to your end customer that environment, I think that can be quite appealing.
Thank you. Here's a question that is, I think, really of very general applicability. And it asks basically, would you mind articulating what the venture capital model is? And the question is, what are venture capitalists looking to invest in? I think the real question is like, the answer is probably like, what's the venture capital model? What are the returns that are sort of generally looked for? And, what's the time horizon for that? Because I think maybe less in FinTech and more in some of these some areas where there's a lot of hardware or deep tech, but that's maybe a bit of a misunderstanding that entrepreneurs have in terms of what venture invests in.
Venture has a box, and this is something that startup founders need to understand. Venture capitalists have a box that they invest in too. It has to be scalable. The business has to be scalable. The business has to be scalable in a profitable manner. You can't just add people to scale it. That's a services business. VCs do not invest in services. Product companies only, preferably. Number two, they are typically minority owners in your company. So they are not like private equity funds that will take majority ownership in the company or even acquire the entire company. VCs do not do that. Generally speaking, VCs will take 20 to 30% ownership in your company, and that too over time. And the size of investment varies fund to fund, but there is a band for each stage of the investment. Seed rounds, maybe $3 to $5 million rounds. Series A, let's say 20 million or so, or 10 to 20 million, I should say. And then Series B rounds can become $30 to $50 million and so on. And then pre-IPO rounds can be $400 million as well. So, and valuation hopefully goes up with each round. Doesn't always happen. We are seeing down rounds in this current market too. So that's what VCs will look for: strong team, strong IP. They will also look for a growth trajectory. How many, you asked, part of your question, Jason, was what's the multiple on their return they're looking for? They're always looking for a home run from each company. They're always asking themselves, is this going to return a 50x? Create a 50x return for my fund? Is this going to return my fund or not? And even if you are pitching to them at a seed stage, they're going to be thinking, is this a big enough market? Is this the right horse? And is this the right jockey to back? So can this company become a $1 billion valued company in 3 to 5 years? Does it even have the potential? And they understand that not all companies reach that level, but does it have the potential? So don't pitch to them if your total market size is $1 billion. If your TAM is $1 billion, sorry, not a fit. No, I'm not talking of myself, I'm saying in general for VCs. So
right.
Hopefully that helps. That gives you certain bullet points around what VCs invest in. It varies. I can't talk at a very generalist level.
No, that was great. No, I think that was very helpful. And unless there are any other sort of comments on that, I know we're kind of closing out our time together. I'd like each of you to maybe be able to share your best contact information in case anyone wants to reach out. You know, if you feel comfortable doing that, you just state what it is and or put it in the chat. It would be helpful. Anuj.
Sure. I'll drop my LinkedIn and my email address on the chat. Thanks again for having me here. And yeah, it was a super enjoyable discussion.
Thank you, David.
Again, yeah, I'll drop my LinkedIn on the chat now, and really enjoyed the discussion. Happy for anyone to contact me. Follow up. Thanks.
Fantastic. Jillian and Sanjit.
Yeah.
I just put my,
Go ahead.
oops. Oh, sorry. I only sent it to hosts and panelists. Okay, I just put my
I make that
LinkedIn,
mistake all the time.
I just put my LinkedIn in the chat, and then my email is just my first name at mourocapital.com.
Yeah, I put my email. You can easily find me on LinkedIn. Just Google search Sanjit Dang, my LinkedIn profile should show up.
Fantastic. And I'm, you know, if you want to connect on LinkedIn for me, Jason Putnam Gordon. With that in mind, I think we'll wrap it up because everyone's got things to do, companies to build, board meetings to go to. I'd like to thank Jillian Cohn at Mouro Capital, David Palmer at Vodafone's digital asset broker, and Anuj Bhardwaj, head of North America at Experian Ventures. Sanjit Dang, who's the chairman and co-founder of UFirst Capital. I want to thank Idea to IPO for organizing today's event and for my firm for sponsoring it. Each of the audience members, whether you are attending live or if you are attending on a time-shifted basis. Thank you very much, and I'll let you get back to building your great companies. Take care. Bye-bye.
Thank you.
Thank you, Jason.
Thanks.
Thank
Thank
you,
you,
everybody.
everyone.
Thank you, Jason.
you.
Thanks, everyone.